April 15th is the deadline. But as you know, Peter, we use Charles Schwab, Fidelity, many other insurance companies and whatnot to place clients' assets in, and they want the money well before that. They don't want a check arriving on April 15th. They want it.
And welcome into the program. This is your game plan for retirement with Northwestern Ohio's resource for a common sense approach to planning for your financial, investment, and retirement future. Formulating the game plan for retirement, it is Chris McIntire, founder of McIntire Retirement Services. Chris, always a pleasure having you here on the program. I guess the word and the news of the day is market volatility and tariffs.
Yeah, it certainly seems to be the theme that has started the first quarter, and looks like it's going to bleed over into the second quarter. And is it good, bad, or indifferent? And I think we're going to talk about some of that here. It's probably a little bit of everything. Depends what side of the aisle you fall on.
Yeah, when we talk about market volatility, Chris, I know that you put plans together that includes the fact that the market is going to have periods of volatility, that has that long-term vision. We should be looking 5 to 10 years into the future if we are investing, not over the last 2 to 3 months of history. But yet I still think that's where people's perspective gets formed from. Are you dealing with calls or concerns or hearing it from investors that you talk to?
Yeah, we certainly do. And, there's a typical similar pattern there. So, they typically come from the same IP addresses, if you will. And we say that laughingly, of course, not we take it serious. People who've spent their entire working career to build up this nest egg and they start pulling some money out of it. They certainly want to see it continue to go up, not go down. And, we've had some pretty volatile days here in the market, some 2 to 4% swings depending on the index. And, probably been a little bit more volatile on the NASDAQ than it has the Dow Jones Industrial Average because, the Dow, we're looking at 30 individual stocks. The NASDAQ, we got 100 or 200, depending on which one you're tracking. The S&P 500 has 500 companies in it. So, the NASDAQ was the worst performer for the first quarter, the S&P 500 the second, and then the Dow was I'll call it the best performer, even though it was a little bit negative for the year. And, and you're going to have that, like you said, Peter, we expect to have periods of volatility. And obviously, the Trump administration is force feeding things through a fire hose while they have all three branches of government. That part of it would make sense. If I was in the same position, you'd want to get things done quickly while you have all three branches of government.
Yeah. Well, I know that, again, diversified long-term strategies helping your clients minimize risk in times of uncertainty and make it through market disruptions. That's the goal of having a written plan, the game plan for retirement, ladies and gentlemen. And if you are uncertain about your plan, you have questions, concerns, would like to get a plan put together, you are always welcome to call McIntire Retirement Services, 419-332-0532, 419-332-0532. 419-332-0532. Do you think this continues, Chris? I know you don't have that crystal ball. You can't see into the future, but what is your gut feeling or what have you been paying attention to that gives you indicators of how long, how deep, how serious this market volatility is?
Well, Peter, I'm a wise man, so I know I read a lot of materials from people that are even wiser than myself. The international markets could certainly be a place to incorporate some assets into because the U.S. market, we've really outperformed, the European market, for example, for a very long time. And
like a quarter century, right? Like all of the 2000s, basically.
yeah, absolutely. And now you're starting to see some assets flow back into that into there, and I emailed and spoke with our investment platform folks, and they said, yep, that could very well be a good position to go into. But, if the U.S. market gets oversold, you want to catch that rebound as well, too. And, use Tesla stock, for example. Personally, I bought Tesla stock. It's down 50% from, and we probably won't go into all of that, but I think it's some crazies out there setting fire to dealerships and cars. Like, what? I would think if we would do a sampling of Tesla drivers, we'd find more Democrats than Republicans probably, driving Tesla. So why are you carving swastikas on somebody's vehicle who you don't know they are? Don't get that, but I'll jump off of that. But I think I just saw it as a buying opportunity. So I bought some. I'm going to buy some more, and hell, I might even buy a Tesla, and I don't care for electric vehicles.
Uh, Buying things when they're half off, when they in some expectation could go back to full price. That's one of the best market moves you might be able to make. I mean, I trying to find deals when they are present in the market is part of investing. And again, Chris, I know your approach is more long term, is not day trading or market timing. It is tried and true kind of principles of investing. But buy when there's value, when things are on sale, is one of those time tested rules of good investing, correct?
Yeah, it absolutely is. And that's the value of reinvested dividends, and I love dividends. I probably own a lot more dividend stocks and ETFs and whatnot than I do anything else in our portfolio. And yep, they might be low and slow, but those dividends keep churning out. And I actually take those dividends and then reinvest them in riskier stocks. So I've got my core portfolio that spins off a nice dividend income. Then I take those dividends, and that's where I'm going to buy my Teslas and my, maybe Nvidias and some other things down the road here as well. So, using the stable piece and using some earnings. So playing with house money, if you will, Peter, if that makes sense to you.
Yeah, sure. And getting back to kind of the what has caused the recent volatility, the market traditionally hates change. We made a big change from one administration to the next. And then on top of that, we've kind of had this status quo with our trade situation and tariffs for quite some time. Trump coming in and immediately disrupting that status quo, more change in the cost of goods, the relations between suppliers and demand, production. So we've heard about this, Chris. I feel like since COVID, the supply chain is really what we're talking about here when we talk about tariffs. And by the way, like a lot of these tariffs he's talking about, those other countries are putting on us too. They're reciprocal in nature.
Exactly, and that's what we're going to be imposing here. As we're talking on the show here, things can change quickly by the time people hear it sometimes. Nobody's 100% sure exactly what's going to come up. Is there going to be a last minute deal? But let's face it, we are the world's largest economy. China is our enemy trying to destroy our economy and then, offloading fentanyl to kill 70 to 100,000 American kids. So, yeah, I mean, we finally have a president, and I don't mean to get political here, but we have someone here that says, look, we can't continue down this path. We can't continue to dig a $2 trillion deficit. Any corporation around the globe would say, we've got to cut expenses. So yeah, if you're coming at government with a business approach, and say, look, we've just been expanding and expanding and expanding. At some point, you have to contract because it will blow up on itself. So, a lot of good people lose their jobs every year. You're reading where, Facebook, Google, Microsoft, they have downsized. Those
Big
are
layoffs. Yeah.
probably very good paying jobs, and they have to do that because they have a responsibility to shareholders and to run a profitable company and so and stay competitive, and having a oversized balloon government that's as crazy inefficient, and like talking about privatizing the US post office, for example. Okay, well, my cousin would be happy because it took 35 days for the Christmas card to make it from California.
I had similar experience there. Yeah, yeah. Talk about the
Yep.
efficiency of the system
Let
and
me, yeah, I'm sorry, Peter, but let's relate this back to the average American worker. Okay.
okay.
So I was watching a news program. It was a business show. It's either Fox Business, CNBC, one of those two. And they were talking yesterday about the American textile industry, and they were dealing with talking to a company who makes all their products here in America with cotton and whatnot, and said we at one point had almost 600,000 workers in the textile industry. We now have less than 100,000. Okay, so where do you think those 500,000 jobs went? I bet they're overseas in a country called China or the Philippines or Vietnam, where the labor is incredibly cheap, right? So if you tariff them and make them raise their standard of living, that's good for the American worker. Okay? Is it good for the American corporation? It might cost a little bit more, but does it raise the standard of living for the lower economic class? That's what he's trying to do.
For the listener of this program, though, Chris, I mean, we want to be prepared ahead of time, ensure our portfolio matches our risk tolerance, have that written plan. But how might this market volatility impact my retirement account, my investments, or even maybe my Social Security? Is there a chance that this has any impact there?
Yeah, let's kind of talk back onto the marketplace there, and what happens into the stock and the bond markets, and obviously the stock market's been very volatile. And what we do for clients, okay, how we help mitigate some of this downside risk is, we use structured notes, which are kind of like 1 year bonds that offer downside protection until the market, like the S&P, the Russell 2000, or the Nasdaq, fall by 30%. So they have 100% principal protection until the market falls by 30%. And what is the likelihood that a whole bunch of that's going to happen to notes issued in every single month? So we use those pieces to mitigate risk. We use buffer strategies where we can, build a buffer to, help navigate downside risk of like the S&P 500. We use our fixed annuities for good interest rates. We use index annuities for 100% principal protection. So there are a lot of ways to mitigate this risk, and depending on somebody's overall risk tolerance, we use a lot of dividend paying stocks that certainly don't have the volatility of a high risk growth stock, for example. Like give it, Nvidia has been a wonderful growth stock. And if you were invested in Nvidia the last 3 years, you've done incredibly well. Okay? But if you were invested in Nvidia this year, it's been pretty painful to watch. So, depending on when you invested in that. But like when the market has really bad days, consumer staples typically help you cushion some of that blow. The Walmarts, the Procter and Gambles, the Johnson and Johnsons is what I mean by staples, right? We still have to brush our teeth, wash our clothes, turn the lights on, utility companies. So number of different ways for retirees who have a lower degree of risk tolerance than maybe Peter, who's like 34. I'm kidding there,
Not.
but
Yeah, a
yeah.
decade off in the wrong direction. Yeah. Well, Chris, I know we've talked about the market volatility. We've talked about the tariffs that are one of the impetus of that market volatility. But the bottom line, like if we have concerns, we should back up and evaluate. Continue to keep that long-term perspective and time horizon, but have a written plan that we can refer back to during times of turbulence, which keeps our goals into the future very clearly defined for us. Working toward those, having that vision, I think, is the most important thing to help us mentally, emotionally, psychologically through periods where the market seems a little scary. And then the tools that are appropriate to achieve those goals come more clearly in focus as well. And that is the process that you work with investors to get to, right? That is the end goal of the game plan for retirement that you put together there at McIntire Retirement Services.
Yeah, absolutely, Peter. And you had mentioned Social Security and kind of that previous segment there we
Yeah.
did. Social Security's got some real funding issues. They just got rid of the windfall elimination provision, the government pension offset. So lots of teachers, policemen, firemen got an increase in their Social Security benefit, right? Well, that did not take any strain off of the system. It added to it. So, what will what will Congress and the Senate and the president end up doing about this at some point in time? And who knows, right? It's a tax piece. They have to either increase the revenues one way or another, or raise retirement ages, or a combination of them. And the sooner they do it, the smaller the changes have to be. And I'm by the time everybody hears this show, I'm going to be 60 years old. Okay. Um, and I'm not too worried about Social Security because they're going to make changes to somebody who's like Peter's age, right? He's not 50 yet, so he's got time to make adjustments. And usually it was been 55. I remember that back when President Bush was in office, they had been talking about privatizing Social Security or something along those lines. And, you know, um,
The problem with that though, Chris, not everybody would do it, right? It is a safety net to protect those among us that wouldn't otherwise maybe have the means or the ability or the discipline to be savers and investors for their financial future. And that's really the purpose. It's an anti-poverty insurance, right? And so I get the thought that, hey, I could do better with my own money, but like for every person who says that and realistically could achieve it, aren't there like five or six that probably wouldn't? Like
Oh
it,
yeah, absolutely. And I've been self-employed since I was 25 years old. So I'm the only one that's put money into my Social Security. And if I could pull my statement up, that's probably $400,000 I've put into it. Okay. And I'm 7 years from being at my full retirement age, but so I'm going to contribute to it for even a little bit more, or a lot more actually.
yep.
Um,
These are the years, right?
Yep, these are the years. And, but if I look at the payout, all right, let's say I'm going to get close to 4,000 bucks a month and I put in, say, 500,000. Man, that's a pretty good payout, right? That's an 8% payout essentially in that ballpark range. That's pretty good. And I would think if they were going to do some sort of privatization on it, they could, maybe the government runs it with a quasi bond and stock portfolio, over the long course of time would probably perform better than, the traditional methods that they do with just basic US government bonds, if you will. And,
Yeah.
you know, and I want to kind of segue into that because we're talking about the bond market here is, if you look at where 10-year government bond yields have come for this year, like as of the recording of this show here today, they were at 4.1%. Okay. Earlier in the year, they were at 4.6. Okay. That means interest rates are going down on loans, on mortgages, on credit cards. So, as the stock market gets more volatile, we might get a lowering of the interest rates that helps unthaw our frozen housing market for the first time home buyers and gets it to be where it's more affordable on the monthly payment side of things. So, that could bode well. I'm of the opinion the Federal Reserve should cut interest rates right now, to help unthaw the housing market. That will open up other economic opportunities. And I know they're in the inflation fight and all that, but when you got millions of Americans wanting to buy houses but can't afford to, there's a fundamental problem right there.
Indeed. Well, we are talking with Chris McIntire. He is president and founder of McIntire Retirement Services, the home for your game plan for retirement, ladies and gentlemen. Getting that written plan put together, uncovering and detailing income, investments, taxes, healthcare, legacy, the plan, mapping it out, discussing the vision, the goals, and then putting together a long-term diversified portfolio and the tools to help you efficiently achieve your goals with clearly defined costs and expectations so that you know what your money is doing, what it's costing you, and what each and every dollar is working toward. Again, that's the game plan for retirement that you can get by calling McIntire Retirement Services and Chris McIntire 419-332-0532. 419-332-0532. 3-2. Chris, we talked about the market and tariffs here. The theme of the program was intended to be spring cleaning, a financial spring cleaning. We are in that time of year. We are in the yellow death season down here in North Carolina, pollen everywhere. And I know not every part of the country has the same kind of pollen that we do, but everywhere has their spring in bloom. And it's the time of year where we notice the cobwebs in the corner, the dust bunnies, we get the honey-do list going, yard work starts up. Financially, there are some things that we can do to tidy up and clean up our situation as well. And it's a good thing to remind folks of those to-do tasks every once in a while around this time of year.
Yeah, Peter, good point to bring up there. And I'm the map behind me says Corolla, so I'm in Corolla, North Carolina here, and my white pickup truck is yellow. The pollen down here is insane, as you know, because you live in that neck of the woods. And we talk about, spring cleaning things. We get right now we're in that mode where people want to put some money into an IRA account. And, April 15th is the deadline. But as you know, Peter, we use Charles Schwab, Fidelity, many other insurance companies and whatnot to place clients' assets in. And they want the money well before that. They don't want a check arriving on April 15th. They want it to be April 1st to maybe April 7th at the very latest so that they can get it reported. So, you want to do your spring cleaning early, late March, early April, not mid-April, I would say.
Yeah. And a couple items on a list here, Chris, that you put together, making that checklist for financial tidiness, the spring cleaning, a great way to refresh your finances, improve your financial and your retirement outlook, review your budget and spending, check and work to improve your credit score, maybe consolidate and pay down debt. Like this is the money in, money out balance and managing that. For a lot of people, that is a notable to do on our lists. If we can tackle those things, we'll probably be a heck of a lot further and feel better about our money.
Yeah, absolutely, Peter. It's nice to do an inventory right now and say, okay, we've got four different accounts set up at four different places. Should we do a spring cleaning and can we merge a couple of these together? A lot of times, like, we use Charles Schwab and Fidelity, and heck, we can even buy CDs through Charles Schwab and Fidelity. We can buy bonds, we can buy stocks. So you can still, have an incredibly diversified, safe strategy and things like that doesn't get all swept up in your overall investment side if you want to carve some money off for a money market account or something.
But Chris, a lot of times people have like the Waffle House plan sort of scattered and covered, right? Oh, I got that covered. It's somewhere. And have things kind of all over the place, squirreled away. Consolidation actually helps diversification and overall portfolio costs in many cases because we can see everything kind of in a neater, cleaner view, and we can actually oftentimes avoid duplication and be more diversified when we consolidate like type of accounts.
Yeah, absolutely. There's efficiencies to managing that asset as well, where you don't have to say, okay, well, it got three different IRAs and three different types of Charles Schwab accounts or something like that. And you might have a Roth IRA, a regular IRA, and then a joint account with your wife or an individual account for yourself. Those you can't bring together. But if you had, an old 401k, another old 401k, and then you've got an IRA, there you might be able to do some aggregation there too and help simplify things, especially when you get to 73, when those required minimum distributions come in. If more is not always best, but less is not always best. So finding the right pieces, like for us, for example, we may have a client that has an annuity and an investment account. We can't do both of those pieces all together. So, right, because an insurance company is different than Fidelity or Charles Schwab. So it's very common to have a couple of different IRA accounts because of the things you're trying to accomplish. Sometimes can't be done at the same place.
But if you've got them just kind of scattered and separated and segregated without any specific purpose to that differentiation, it just creates more headache for yourself, especially as you near those RMD ages. And especially if you have different types of accounts, right? If you got an IRA over here and a 403B and a 401k, those are different calculations in many cases for how you have to handle those RMDs. Would be easier to just sort of consolidate and have less to deal with there.
Yeah, certainly would, Peter. Yep. And we were talking a little bit more about the the portfolio mix there. And I wanted to talk about most people are familiar with a 60-40 portfolio, 60% stocks, 40% bonds. Okay.
Hmm.
Let's just use a 50-50 portfolio to make the math easy here. Okay. So I got 50% in stocks, 50% in bonds. What's better about 2024 into 2025 is that bonds are providing that extra layer of protection, can when compared to stocks that have been very volatile. This isn't 2022 where they're raising interest rates and our bond prices are going down. The bonds are doing their normal defensive play, if you will. So let's say you had 50% in a bond portfolio, 50% in a stock portfolio, and the market went down by 20%. So 50% of your portfolio went down by 10. The other 50% may not have gone down at all. In fact, it may have gone up just a bit because of the flight to safety. So, in that aggregation, yep, your stocks are down 10, your bonds aren't down at all. So you're down about 5%. That's probably not enough to make you lose sleep or hit the sell button, because that's when you realize that's when you've lost money, is when you hit the sell button.
Yep.
When you log in at the end of the day and look at the value of your account, okay, that's if you sold it.
Yeah.
It doesn't affect the income, most likely, the interest off of the bonds, the dividends off the stocks. It's just the value of them if you hit the sell button that day. And for some people, that's hard to realize because they're plotting, it makes their Excel spreadsheets or their dot plots, a little less relevant probably.
But when we see this kind of market volatility and we've got those two sides going, Chris, may be a good time to rebalance or even contribute, maximize your retirement savings contributions, optimize your tax strategies, consider Roth conversions, reassess the investment portfolio. Just back up and do a holistic review, especially of insurance policies and beneficiaries. All of these things are on your list of the financial spring cleaning to-do tasks. A lot goes into having a clean plan, and that's what you do there at McIntire Retirement Services, putting together the game plan for retirement, helping people with those to-do tasks and the routine maintenance and the spring cleaning, the financial spring cleaning. Also, giving them that long-term vision to navigate what can be turbulent, volatile markets and keep a steady frame of mind and a good psychology when we do see a little bit of that market turbulence. So, Chris, I always appreciate the time here on the program. We got to bring it to a close, but I do want to remind you, ladies and gentlemen, viewers, listeners to the radio program, if you would like to get together your game plan for retirement there, McIntire Retirement Services. Pick up the phone, give a call, 419-332-0532, 419-332-0532. You can also go online, McIntyreRetirementServices.com, McIntyreRetirementServices.com. Chris, enjoy Corolla. Always a pleasure seeing you, and great to have you here in North Carolina.
All right, buddy. Yep, good to be here, and I can't wait to get back to Ohio where I can breathe again.
Tune into Chris McIntire's full radio program and visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Structured notes involve risks not associated with an investment in ordinary debt securities. The securities are not bank deposits and not insured by the Federal Deposit Insurance Corporation, FDIC, nor any other government agency. They are not obligations of or guaranteed by a bank. The securities will not be listed on any securities exchange, and secondary trading may be limited. Therefore, there may be little or no secondary market for these securities. Accordingly, you should be willing to hold your securities to maturity. The securities are subject to the credit risk of the issuing bank, and any actual or anticipated changes to its credit rating or credit spreads may adversely affect the market value of the securities.